Flying high in April, shot down in May. But boy, are we gonna be singing that tune when we're back on top in June. New month, everybody. New attitude.
Pinch punch, Dale.
What's that?
Pinch punch, first of the month.
Oh, yeah, I never heard that.
You never heard that one? You got to go up to someone and go pinch them, punch them, and say first of the month, and then you got to say no return. They can't get you back.
Is that something like
every month? I get the kids.
Is that like slug bug?
What?
You don't remember slug bug?
No, I don't either, Blake.
What?
No.
Yeah.
Anyway,
you know,
I missed out. I have a hole in my life.
You don't remember when you drive down the road and you punch somebody every time you saw a VW bug driving down the road?
Oh, no.
And you say slug bug, you got to hit them first. You know, if
yeah,
you get
we
hit
all
first
found. Isn't it funny how we all found games so we could take a shot at our best friend right in the shoulder?
Right.
Huh?
Back before video games. Before video games.
See, we got together, you know. We could, beat each other up. anyway, start with Dixie. So yesterday, I put the position on here and I made the point. I'm not going to put my stop right above this high. So I said 50 pips stop. And it got within 30 of the stop. But let your stops breathe. I know there were a lot of people that, saw this candle. I'll put my stop here. There could always be one more jiggle. Can't there, guys? I mean, usually, when you think you have it, the market could play in that area that needed to distribute one more time. And if you're just putting your stops in obvious places where everyone else's are, you're going to be right the market, wrong the trade your whole life. And, that there's nothing more frustrating. Use less leverage so you could use a wider stop. That's my homily for today after my Frank Sinatra opening. So silver down. What do you think, Ryan? This pound really, I mean, maybe if we get to 20, the rally in the euro, I mean, it is, it just can't get going. What do you think is happening here? Do you think they're worried about perhaps the escalation of the Ukraine war here? And
no, I think,
and having a channel of water between you and a ground war is a good thing to have?
No, considering there's probably a ton of Russian subs swimming up and down it already. So that's not.
Oh yeah, that's right. Yeah.
I think it's the pure divergence play because euro sterling's going. Usually if euro dollar's moving and cable's moving, they're both going the same way. But the pound is having one of its moments where it's it's shining and saying, "Look at me." You know what cable's like. We said it before. It can be at 120, and the next minute it can be at 125, and you scratch your head as to what happened. I think we could be seeing the pound, slowly moving again. Be interesting if it gets up to those 126 highs that we had previously in cable. That's really the target you've got to set yourself for a real test. If the pound is not just going to range, it needs to bust through there, and then we're off to the races. Probably looking at 130 not long after.
Okay. Did anyone think that the market would be stronger both yesterday, because there was a deal, and then today because it got through the House? What do you think? I mean, it's not exactly a big celebration. And in fact, I looked at this last night and there was, I don't know, where was it? This was a candle. So it passed the House and it rallied right to here and sold off. I'm not saying it looks terrible and it can't just grind higher, take out this high, but I'm a little surprised at the response of the market.
We're having this discussion on the flow show between all the viewers and Stel and myself. I don't know. Stel's, Stel will speak for himself, no doubt. He's of the opinion that maybe we get a last hurrah on it passing the second House or the Senate. I'm inclined to think maybe the market's maybe traded it already. It's going to pass.
That's the thing. It's a Democratic controlled
exactly
Senate. So
Yeah,
theoretically today should be the day that we gap higher and then move lower.
So what do you think, Blake? That it's not making much headway. Plus, they've also taken lowered the probabilities of a hike by the Fed next month too, and yields are dropping. We're getting to a pretty critical point. Jim Welsh is going to probably end up being right, but the 10.
I think that was the biggest thing yesterday. The rate expectations doing a complete 180, just on Harker and Jefferson.
Right.
And Harker has been speaking about pausing since February. I look back at me flow show notes to see what he said previously, and he said in February, if we get above 5%, he's going to want to pause. And the market's seen his comments yesterday as if they're brand new. But it's a complete flip around in rate expectations. But you wouldn't know it looking at FX.
Yeah, you wouldn't.
Actually, you wouldn't know a lot by looking at FX right now.
Yeah, it's not telling us much, is it?
No, it's not. We're not getting a whole lot. But I'll tell you, Dale, and Ryan, you can probably sympathize. And I don't know if you were doing this, but I was trying to get short some dollar yen last night. I had orders out at literally 139.98, and it missed my order maybe by a pip or two, whatever I was so frustrated. Because that's the kind of trading that I have to do is I have to place orders in European hours, hoping they're going to get triggered. I hope they're going to get filled, because I know that by the time I wake up, we're not going to see that level again, or we'll be lucky to see that level again. So that's the kind of trading I have to do in this type of market. How are you navigating through this, Ryan?
Well, funny enough, I am completely flat on the book. I got my trailing stop went on my Aussie from the short from 68. That got triggered on my stop, so I'm out of that. I had a scalp short at 107 in euro dollar. Funny enough, talk about stops. I moved my stop on the trailer to entry +1, and it got nicked by 0.3 of a pip. So
that sucks.
Yeah, one of those days, isn't it? Traders luck.
It's like, this is the kind of market, and Dale, this, when it feels like they know exactly where you're at, right?
Yeah.
Like the market makers know exactly where your orders are at. They know.
Does this action in the yen really look that bearish? I know it's grinding down. And 138.
Can I give you the longer term view, Dale, in case you haven't seen it?
Yeah, go ahead.
I'll do because that's a good question. So and would I say it looks bearish yet? The answer to that, in my opinion, is no, it doesn't. It doesn't look bearish just yet. And by the way, the comments, if you want to go back and see what comments Ryan was talking about with Harker is in through here. You can go through the live spot feed anyway. So this is the way I'm viewing it, and I've viewed it for a while, Dale. It's it's just a simple Gartley pattern, or is it a crab, or is it a monkey pattern? I forget. That's an inside joke, by the way. So I think that we might have completed this move at the 161% extension. And so now when you say it doesn't really look bearish, now that we've broken through this channel, you can see this ascending channel that we've been in. We're challenging the underside of it. And that's why I'm like, okay, give me the round number, give me a move to 140. And I'll get on the short side. It'll be the underside of this trend line. And I don't want to be aggressively short until you're back below 138. Back below 138. Yeah, that's when. So like when you trade counter trend, I'm going to give you guys a little lesson in how I navigate through the markets, especially when I start trading counter trend. For me, if I can identify, okay, like in this example, 161% extension, that I know this is our stopping point, right? It's this 161% extension of this move, basically. And so when I can identify that the high has been in, then I can start getting short with smaller positions with stops above these highs, maybe a little higher than that, but you can start getting short knowing where your risk is. Then once you start drifting lower, you start adding to your winning trade. So if you're short here, you add here, then you get aggressive here. So by the time you're in a full size or even more aggressive than a full size short and momentum has shifted, you can actually get your stop to break even. That is my goal on each and every counter trend trade that I do. I hope that made sense to you guys, but I start by sticking a toe in, seeing if the water's warm, right? And if it's still too cold, I'll have to pull my toe out, or I have to get my toe will fall off from frostbite. And then then if it starts to warm up, then I can add to my position as it's moving in my direction in a positive trade, so I can eventually get my stops to break even. And by the time I'm full size and I got the trade that's actually going in the direction that I want it to be going, then at that point in time, I have a full size position and I can move my stop to break even. That's how you trade counter trend. And if you don't know how to do that concept, make sure you jump in the ForexAnalytix chat room. Make sure you jump in here in our general chat room. Talk to us about it, because this is where we discuss these types of things. All right.
That's like a campaign trade where you have a great quarter in a few weeks.
Yeah.
If it goes like that, those are the trades that make your year, right, Blake?
They are, and they're not. They don't
often happen all the time.
Yeah, no. I mean, I'll be lucky if I can squeeze one of those out every month or two. Like a really, really good one where it's like makes my quarter. But that's the way we do it. All right. Anyway, hey, we have ADP non-farm coming out. What do you think, Ryan? Are we at that turning point? I asked it's still 5 o'clock in the morning for us, Dale. So I still lose. I can't talk always at this time in the morning, but I was talking to Chris Weston last night on the trade-off, and asking him if he thinks that the jobs market might be turning. What are your thoughts here on like ADP non-farm and non-farm payroll, by the way?
It's a jobs market turning. We've been asking that for the last 12 months or more.
Yeah. 14 months, right?
I've given up asking. It will turn when it turns, and until then, we just keep guessing. Speaking of which, don't forget the NFP competition. I've just put the link to the tweet in the chat function there.
Yes. Make sure that you guys go make your guess, because you can, even if you are part of the ForexAnalytix community, if you guess and you're one of the three, you'll still get a free month. We just tack it on your account. So that happens all the time. So
yeah. So we're expecting 170K this month versus 296 last month.
That's for today.
It's a lottery. It's a complete lottery. But the market
very volatile.
I'll be more inclined to watch the initial jobless later on, because that had a real big pullback. That dropped a big chunk last week, which again is another strong reading. We had a strong reading from Jolts yesterday, undid the whole of the lower trend in the Jolts numbers. And that actually caused Fed rate expectations to rise. Market was pricing 70% chance of a 25 pip hike, and then after we got those Fed members, it went to a 60% chance of a hold. So the data at the moment potentially is going to flip all these Fed expectations around, and you just got to watch out. You might, strong ADP, you might get your 140 in dollar yen, Blake.
Yeah, well, I've actually got some orders out there. So we have the dollar yen on the far left. We have the S&P right here. Steve, just heard your voice. Good to hear you. We got yields right over here to see how they're reacting. I'm going to leave dollar yen because I think you're going to get the most asymmetric response from this move. 170 is what the market's looking for. We've got approximately 2 seconds. Here we go.
278.
Boom, I got hit. I got hit. I got triggered. I got triggered at
Okay.
139.85 on a short on the dollar yen. I'm immediately up 15 pips.
So a much
Nice.
better number that will obviously lead to much better expectations having to do with the
The Fed.
NFPs.
Yeah. Oh, okay.
And of course, that will also affect the market perception about what the Fed will do next, as you said, Dale.
Yeah, so let's see. You know, it's interesting. I didn't even see price get up there here on whoops, that's not well, that's on the dollar yen. I just got triggered immediately when we were just sitting there. So it's interesting. What do you think of the initial response there, Ryan?
Yeah, to be expected. We're flipping around again. It's when another month we're gonna have to wait for the jobs market to collapse.
Yeah, one more month. We're gonna wait one more month. So Steve,
One more. It's like being at a concert asking for another song, isn't it? One more.
yeah, encore.
Oh, okay. That's life.
There we
That's
go.
what people.
Thank you, Dale. That's exactly
All
what
right.
we needed. Hey, so Steve, we've got, you know, obviously non-farm payroll tomorrow. Do you have any views here? Because this will be, and I was just telling, you know, the guys, and I know you just popped in here. I was having this conversation with Chris Weston last night on the trade-off, and this will be the 14th month of you know, jobs gains, and would be, you know, of beating expectations. If you look at here's tomorrow's, you know, what market's looking for 190,000. Maybe right here. So we're looking for 190,000. And if you look
and my assumption is that after today's ADPs, the market will start assuming that we might have a better number.
Oh yeah, so then that's a great point. What do you think here? And what do you think? Because expectations now have to be through the roof that we're going to get a 200,000 print right now.
Definitely, let's say that expectations that it's going to be a big miss will practically go near zero, right? So I'm going to say literally deja vu, the same thing I say every time you ask me when we have this type of data, is that I don't like to make assumptions and trade based on them. Ryan said it very nicely before, just another month, meaning assuming every month, it's the same thing I say with following trends, assuming that every little pullback you have in a chart is a reversal instead of a pullback is an ill-advised approach, right? So assuming that employment data will just start suddenly collapsing with this month being the beginning is an ill-advised approach. So especially now that we have ADPs, assuming that tomorrow's NFPs will be bad is an ill-advised policy. So I think that the NFPs are going to be probably fine. Now, are they going to be good? Are they going to be more or less as expected? In the grand scheme of things, I don't think it makes much of a difference, because from these data that we're getting these days, I think they, in essence, favor a further rebound in the dollar that we've been seeing unfolding for the last 2 days.
All right. So you know, Dale, what are your thoughts here with the jobs? You know, I mean, it's been a pretty strong labor market.
Yeah, you know, I don't know why it's going to change, because this is secular thing. So, you know, people left the workforce after COVID, and a lot of people aren't coming back, and a lot of people are retiring, and we're not letting many, you know, immigration. I don't know if that's helping. We have a demographic problem, period, but workers, that's what I mean. The Fed is fighting two fundamental things that really monetary policy, only if you cause a depression, it'll affect. They're targeting housing, which there's a shortage of stock of housing. Simple, not enough homes. So how do you break the housing market that way? In fact, certain areas are rebounding. And then employment. How do you correct a secular trend of, office spaces being empty and commercial office space, a lot of people walking away, giving the keys back to the bank? With monetary policy, you would have to hand out, get in a time machine and have a ton of Viagra and fly over the country and drop Viagra to solve the problem we have today. What do you think?
Well,
How does Fed policy affect those two trends? They can't.
Yeah, one of the things I wanted to say is you mentioned housing, and I was just listening to an economist regarding this earlier this week. Most, like, at least in the United States, we can talk about probably other countries as well. Here in the United States, most Americans that own homes are, their mortgages are sub 5%. So that you're getting to that point where they can't afford to get out of their home. They don't.
No, the only way it'll happen is if they lose them.
Yeah, and so you got, and then you got to ask the question, like, what's going to turn the housing market? Like, what can turn the housing market? And in my opinion, it would be only when you start to see, the jobs picture really sour, and then, people that own multiple homes, which, Airbnbs, or, which make up
BlackRock, if BlackRock went upside down,
if
they're the biggest landlord.
They got out of the housing market, or out of the rental properties, but that's only about 7% of all the homes out there. You know what I mean?
Oh, so they got out of it?
No, that are owned, that are rental properties in the United States. It's only like
all their mortgages that have, especially those that have locked in rates, are a gold mine for whoever has them, right?
Yeah,
literally gold mine, because with inflation being what it is, let me give you a personal example, right? My best man bought 10 years ago a house in London because he lived and worked there. He bought it for 950,000 pounds. Since he was a banker, he got an even extra special rate, something like 1.75%, locked in until the first 12 years or something like that. So he has still a couple of years left. The house has appreciated from 950 to 1.6 million. And with inflation being 10% in the UK, he still pays less than 2% of a mortgage rate, right? He has the money to repay it tomorrow if he wanted. But why the hell would he do that? I mean, they in essence pay him to owe the money.
Yeah, it doesn't.
Why would you want to do that?
Yeah, it doesn't make any sense right now, and it doesn't for most people. And the way you're going to change that again is just
they have to lose their homes.
They have to not
lose their jobs first.
Jobs. Yeah. And then they have to get rid of their second properties, and you might see some inventory come back on the market. So anyway, it's a really interesting position that the Fed's been put in, and all central banks really globally.
They chose their targets, the two worst targets for them to be able to be successful with: labor and housing.
Hey, in just a few minutes, we do have unemployment claims that we will cover live before you bring on your next guest. But really quick, Ryan, let me go to you first. What are you thinking as far as wrapping up the week? How are you preparing? Like, for me, I just shorted some dollar yen. I'm glad I got short some in the 80s. I hit one of my 2 orders out there. I think that we're going to be below expectations. I don't think we're going to get a 100,000 job print. I don't think anything like that. I just think that we're going to come in near expectations, and that's going to be soft for the market, because the market whisper number is going to be higher now, especially after today. So, if the market's looking for 190,000 jobs, they're realistically for tomorrow, we're they're thinking 200, 215, 220.
Whisper it.
Yeah, they're whispering. They're thinking about 200.
Don't tell anyone.
Don't tell anyone. And so, yeah, right. And so I think that the number is going to come in, softer, like, 180, 170. Therefore, I think the dollar is going to get hit. So I'm preparing by being short the dollar yen today. So by tomorrow, hopefully we're trading close to 139. I can be in a nice profitable position to add to that on a week data. That's how I position myself ahead of data. That's what I'm doing. What are you going to do ahead of tomorrow?
Ahead of tomorrow, I'll get a good night's sleep. Probably
drink a beer.
I think we're in the same position with the NFP that we have been for months. Unless there's a big outlier negative, the market takes everything as positive. As long as it's a plus number, as long as it's not less than sort of 100k, 50k, anything like that, the market's going to go, yeah, jobs are still cooking, keeps the Fed going. But I think the market, looking at the price reaction to this ADP, the market hit that rally as quick as they could. It's looking like we're trading the pause in June, and so that data's got to do a lot to change that around again tomorrow. So I'll, aside from the headline number, I'll be looking at the wages. That's important for inflation. I'll be looking at the unemployment rate and that important participation rate as well to see if there's real strength in the market.
Yeah, anything that you're looking for as far as like the average hourly earnings. I mean, that's like the deflationary forces coming through the market, right? Starts
here. Yeah, because you remember, the market's flipped overnight on rate expectations, yet PCE in both counts was higher last month. So inflation hasn't gone away. It's been falling, but it maybe pausing. Average hourly earnings are expected in at 4.4%. The unemployment rate's expected to rise to 3.5% by a pip. If unemployment rate's down, wages are up strong, then a hike goes back on the table, and dollar strengthens again likely.
Gotcha. All right. Well, thanks, Ryan. Dale, what are your thoughts here?
I'm just watching the Dixie here. I want to buy a break. I'd like it big picture 10, as close to 102 as possible. But I think it's going to be real choppy getting there. We could go to 3.5 and then pop, make a marginal new high, and then come down. Anyway, if you're patient and just wait for that area, it may take 3 weeks for all of this to play out. But I want to buy a break in the dollar because I think this 400 pip move that we've had off the lows, correct just 50%, and then look for 1.618 from 102 is going to give you 108. So I'm looking for us to take out that 105.80 level.
Woo! That would be a big
side.
move. All right, Steve, what are your thoughts here? We got about a minute before the weekly unemployment claims. What are you thinking?
Now, having to do with what's important, right? With how the market is going to be moving from here. We're seeing the dollar stalling a little bit here, but stalling and reversing are two different stories. So I think especially if the data, the remaining data today and the data tomorrow come in decent, I don't see it easy for this dollar rebound to finish already. So I think we're still in this corrective rebound higher until proven otherwise. So I wouldn't be advising really for people to be buying the dollar because in general I consider it a counter trend move, but I don't think it's time yet to short the dollar.
All right. Well, it sounds like you're in the same camp as Dale. You want to be buying dips here. Thank you for your input there. We have just about a minute before, actually 30 seconds before this weekly unemployment claims comes out. I'm going to take this opportunity to say, if you're not part of the ForexAnalytix community, make sure you jump in there. You can jump in our chat rooms. You can be part of our community where you can say hi to all of us and all the other traders that are in there. Some people have been with me for like literally 20 years, like Rick, I've met him in person actually multiple times. So make sure that you're jumping in there. Here's the dollar index. Here's the S&P. Here is the yields. And let me grab the data flash. And whoops, looks like unemployment
There we go.
just came out. Here we go. And what did we get?
Productivity negative, which is very, very bad news, but it was expected to be negative -2.1 quarter on quarter.
Well, it was twice as bad.
US
then, right?
unit labor costs 4.2.
Initial
And
jobless
initial
claims.
jobless claims practically as expected.
Yields are dropping.
Yields are dropping. They're actually coming
Gapping.
off here, and I'm glad I got short some dollar yen this morning. That's great.
Nice trade, Blake.
Thanks, man. All right, guys. Well, hey, I know you're gonna have I know you have
My guess, you know what he does? He makes bad charts.
he makes bad charts. Hey, do you know, before you go to your guest, do you know Stelios is out with he's meeting with one of the politicians in Athens today, one of his buddies. It's kind of like if Dale, you went to go meet Bernie Sanders or something.
Oh, wow. Yeah, Stell's an advisor.
Yeah.
Yeah. Well,
Bernie Sanders is probably not the type of
Although
politician he's currently meeting. I can guarantee you that because
Oh,
I know the guy in
maybe it's
person
like
as well.
of Fukudakis. What was that? What was that economist name? The bald guy.
Oh my God.
What's his name? God, did you guys have
Varoufakis.
Varoufakis. That's it.
Yeah, please don't
Yeah.
even mention that clown.
Oh man,
Steve
I'm gonna. I've actually shaved my head and I've got a Harley and I've been cruising around my town thinking I was Varoufakis. So anyway, all right, guys. Hey, have a great interview, Dale. Steve, thanks for being
Blake.
here. Ryan, thanks for being
team.
here. Dale, thank you for
Cheers,
always
guys.
being
All
here.
right.
Cheers. Bye-bye.
Cheers,
Enjoy the
cheers,
interview.
guys. Mates. See you, mates.
And thanks everybody for your support. Ciao.
Patrick, show us some of those bad charts, buddy.
Hey, hi Dale.
Hey, great I know time flies. Seems like Groundhog Day, doesn't it? A little bit.
Is it 3 months since the last time we talked already?
Yeah, that's kind of like what the cycle is. 3 to 4. It's amazing.
That is incredible.
It goes even faster the older you get.
No kidding.
So appreciate
it's like
the time. Yeah.
That's right. Because your brain has more and more input. It's always working. So when you're not idle, remember when you were a kid there, the summers, they used to last forever because you'd be just like, you wouldn't think, no stress, nothing, just have fun. And that really slows down the time.
So what's this that we're looking at, my
Well,
trading warrior
the initial claims for me
claims.
is probably the most important macroeconomic macroeconomic indicator. And I'll tell you, look, and you're gonna probably answer me this question. Okay, so here you have the initial claims from 19 wait, my panel
goes in the 70s.
From the 70s. Okay, so look at this. I've looked at so many charts, Dale, that right now, what I notice when I see a chart, I just don't see a chart, and they're like, when you're doing something new for the first time, you're overwhelmed, so you don't see the big picture. You're there, okay, where's it going next? But I've seen so many charts. When I popped up that chart, I think maybe a month ago, I had a revelation. I'll tell you exactly what that chart looks like, and you're gonna fall off your seat, and then we could discuss which one leads which. I'm gonna pop up the gold and silver miner index of miners. So it's an index, so they rotate out the least performing one. It's the ASA one. And here it is. Here's the ASA chart, the gold and silver. And look at that. Let's bring your eyes, guys. The amplitudes, yes, are different, but look, bring your eyes here back in the 60s.
Yeah.
It tracks, it probably leads the initial claims, right? And look at this. It follows to pretty much a good heartbeat the initial claims. As initial claims go up, the miners go in uptrend. Here, initial claims go down, miners get sold off, or it's the inverse. It's the macro. I'll show you another chart to complement the macro landscape of why this is probably happening. And look at that spike up in the initial claims in 2020. Remember that March Madness, and then after that they go up. And look at that. Look, it's tracking to
exactly now.
Pretty much sync. So I know when I zoom out, the correlation, yes, it's not 100%, but if I have a breakout in initial claims and I have a breakout, some positive stuff happening for the miners, then I know I have a higher probability chance of having a successful run. And as a chart trader, it's not about percentage moves. And I'm happy you guys are like, you guys do Forex and you understand that the most. People always tell me, oh, well, look, gold moves 10%, 20%, Bitcoin move 1,000%. But look, Forex traders, currencies don't move hundreds of percents, but you can make as much money trading currencies than you could anything else. It's all about position size. It's about risk and money management, where you put your sell stop, where's your profit limit, right? So it's not about the percentage move. It's about identifying the higher
being on the right
run,
side.
right?
It's all about being on the right side.
Yes, yes. It's all about that. Yes, the right side. And after that, fiddle around with your position size and you'll be able to leverage the move. So the miners, I'm pretty sure maybe this is a huge pattern, but it's not, look, they're not there yet. There's something really.
Would you consider, Patrick, especially the silver miners? They've come off pretty dramatically in comparison with the physical. The gold miners have held up better, although GDX went from 36 to 30. But I look at AG is almost at new lows. SILJ is at major support. And I'm not sure this silver correction is completed unless we get back above 24 and a half. Why, you know, I know people ask you this all the time. Why are the miners giving up so much on this pullback in silver?
Well, this chart is part of it. I'll show you two other macro ratio charts that are gonna, and people are gonna start understanding that why the capital flows aren't going to miners. Look, this is SILJ, guys. Look, silver miner, gold miner, I don't care. Look, SILJ tracks the ASA, the gold and silver miner index. I could have put Pan American. Remember Pan American? This one has a little bit more data. And let me just put that on the log scale to match it and zoom it down. And look at the ASA chart. It's the same thing, guys. Look, there's no, if you're precious metals, gold or silver, it's pretty much the same capital flows. Look at driving these charts. So even if SILJ, I don't have data going back to the 2000s, and I could assume that SILJ chart would practically look like the gold and silver miners chart if I were to stretch it back. So I'm gonna circle back. I'm gonna show you the gold to SPX. Here's my gold to SPX chart, overlaid the initial claims. And that also tracks the initial claim. So gold's outperformance of SPX of growth stocks increases when initial claims start rocking it upwards. And I think the initial claims is something the Fed probably looks at closely, and they react probably monetary wise, either lower the rates or whatever. And that really spooks them, initial claims spiking up, right? Isn't it one of their
that's
legal
what they
mandates
want
for
they have well, that's what they want now. They want to create unemployment. They want initial claims to go up. It's been stubborn.
Well, if it goes up, then gold's going to outperform SPX. So that's where you want to go long. So look, gold versus SPX follows that.
Okay.
If I overlay, if we know that gold SPX tracks the initial claims, and we know that as a chart tracks the initial claims, those are huge parts of the equation. And I'll show you another crazy chart. It's so
that, you know, that really, so something that precious metal traders should pay attention to is, you know, they probably own stuff now, but the time to get aggressive, and, you know, we just looked at initial claims. So, well, you know, is when they start going up dramatically. That would be when the Fed would pause and maybe pivot, which is constructive. It's about, it sounds like it's all about rates. Everything is all about rates.
It's about more than rates. It's about the destruction of purchasing power. Okay, maybe that's the best chart I could show you, because essentially it's precious metals react, because they're just rocks and they're just something static. They react to the fiat losing its purchasing power, and essentially the purchasing power of fiat is its strength or weakness versus other currencies,
right?
But also that it adjusted for inflation. And that's really the purchasing power, how it is. So here's I got
So do you
sidetracked.
think, and I know you've talked about it before, do you and Kevin think that we could have a dollar rally, which, we had not so bounce so far, and a continuation of a bull move in gold
Definitely 100%.
simultaneously?
Yes. Okay. I'll show you that one there to answer move that. Here, I'll put the DXY. And here I'll put on top, I'll put just gold. I'll just remove well, gold's at the bottom pane. Perfect. So here's what we got. We got gold in the bottom pane. We have DXY on the top. And this is why people get confused, because gold does not track necessarily the DXY. It tracks the inflation adjusted version of the DXY. Look at this here. When gold was bottoming, look at that here. Huge bottom right here. I'll zoom in there to really show you in the 2000s. Huge capitulation bottom. Look what the DXY did. Kept going up, but gold refused to do a lower low. And DXY kept going up here. It's here. It's about at 116. It dips. It goes even overheats to 120. But gold was going up along the DXY along here. Here, look at this here, another region. Look at the DXY going up. See that DXY region here going up? And gold did not care. So
Great
this is what gold reacts to. It's the DXY divided by PPIA, a proxy for inflation. Now look at this thing. Okay, so it's invert. So this, I'll invert the gold chart. I don't know. I'll put them one on top of the other. I'll change the color to red for my gold chart. And look at that now. This should really, people should really say, oh my goodness, this is what gold tracks. So while the DXY, we know in 1985, the DXY, it was a plaza chord and it went bonkers, right? And it did a new high. It did a higher high in the 1980s, mid 85, than it did in 1970s, the DXY. But inflation, it was so much inflation adjusted that its purchasing power was down, and gold, look, it tracks that. Look at that, it tracks that. So now you got another clue, guys. If the DXY adjusted for PPI is still in a downtrend and not breaking out, and it seems, this seems like just a back test, pole flag, right? It depends. It's not, this has to break down here. Look at the gold chart, what it's been doing. Actually, the gold chart leads, look. Okay, that's another thing, Dale. Whenever I look, people always look, okay, where's gold going to go? And then you start looking at macro stuff, other charts. But look, the highest of the pyramid is the gold chart. It's the leader. It sniffs out. I'll just show you here. Look, it sniffed out. Look, when gold broke out in June of 2019 here, or where's my gold chart? Is it that one? Here, in June of 2019. Right here. Hold on. Put this line here. When gold broke out here of its, well, it's inverse, guys, right? I'm sorry to confuse guys, just to keep in mind. When it broke out in 2019, in June, the DXY adjusted for inflation was still going up, but gold was telling us that that was only going to be temporary. It led it by 5-6 months. And right here, gold peaked before. So here in August of 2020, gold peaked while the DXY adjusted for inflation was catching up, right? The producer price index, whatever, how they calculate that, the data was coming in, right? Higher oil prices, that's all lagging stuff. Now you got to look at the gold price, because gold, if it breaks out of this 2-year consolidation here and it breaks out upwards, it's telling us that there's a high likelihood that the DXY adjusted for inflation has a much higher chance of going down. But I think, like, talking about this out loud, people who want to play the DXY or play inflation, they should actually look at gold's price action, and that should give them some clues to where the DXY's relative strength versus the euro might be going, but also where inflation could be going. So let's say the DXY does go up and it hangs on versus the euro, right? Because the DXY essentially, it's its performance versus the euro. It hangs in there versus the euro or outperforms it. If some crazy thing happens in the PPI, oil prices start going up and outperforms that strength of the US dollar versus the euro, then gold's going to price that in and gold's going to go up.
Okay. Do you have your breakout in the Dow gold ratio?
Yes.
Or did it back off from the breakout?
The Dow, is the weakest. So people look at the Nasdaq, and I
Yeah.
was looking at breadth for major US indices. Seriously, other than the Nasdaq,
Yeah.
it's not looking good at all. At all. The Russell, the Dow is not looking
Yeah.
good. The SPX, not that bad. So I'll just remove indicators, remove my drawings. Look at that. That's the Dow versus gold. There is nothing. It broke here a line of support, so that's momentum. It's pretty acute.
Yeah.
So
Yeah.
it's still trying to go upwards, right? It's not dead yet. Look at this thing here. Oh my goodness, Dale.
Yeah. It's on
Look
the
at that.
verge. Yeah.
Could even make a case that if it closes the month there, it's
Yeah.
losing momentum. It's not the final breakdown line, right? It's not the horizontal breakdown line that confirms that the momentum but it's heading into neutral territory. So when you're in neutral territory, you have a higher, now you don't have the tailwinds, right? You're starting to get headwinds, and that could be a big breakdown. It could be, and look at this level. Look where it halted. It halted.
Yeah.
We're back here at the 1972 top for the gold versus Dow. Well, here, I don't like too much before the 1970s because gold was kind of pegged, but this is topping area for Dow's outperformance of gold. And you cannot be bullish, the Dow outperforming gold, until it gets back above this line. The Dow has to get back above this line to tell us that we're going back into a growth cycle for 5-10 years. It's more on the verge of breaking down. I could do the Russell.
Yeah. I know the Russell's been the weak sister.
Yes. There you go. Look, the Russell's like even lower below. I'll put it on the candles. You can even make a case that it broke down and now it's just bear flagging below a breakdown line.
Mhm.
That's not good, Dale. You don't want to be there.
Yeah.
You're just
So
not.
how
You're
are
on the
you,
wrong
how are you
side.
telling your subscribers to position themselves at this juncture? Are you saying, wait, put partial positions on? It depends on, leverage or physical. What are you advising people that subscribe to your letter?
Well, right now it's in no man's land. So you really want gold to break out. It's too close for comfort, and especially now we're close to the end of the quarter. Some crazy stuff could happen in June, right? Here's my gold to SPX. Here I have a crazy pivot line at 0.5 half, and for a few months it tried. Look at this, even here, 0.47. It tried to get back above. Look at the selling pressure. So every time everybody thought gold was breaking out, it got sold into. But it's not doing lower lows. It's not doing lower lows, and it's hitting on that wall. So if ever we get a close, even a solid close above 0.479, 478, ideally 0.5. So if I get a monthly close here, man, you got to get uber bullish. Then you take I don't want to say huge, but then you load up on gold. Then you load up maybe on the miners, but primarily on gold. Because you got to remember this is a gold versus SPX chart. Both can be going up at the same time, right?
Right. Yeah.
So you don't want to short the SPX. And I don't like shorting US equities because the purchasing power destruction that they'll do to nominally keep it afloat will put some type of floor under the US equities. But on the flip side, gold will price in that crazy destruction of purchasing power. So you want to go along something that's not bright, that's going to run up more, because if this ratio goes up, even if the SPX goes sideways, that means gold is outperforming SPX, right? And that's where you want to be. You want to be in the asset which is outperforming the other assets, even if both go up. That's often people say, "Oh, Patrick, I love Bitcoin. Bitcoin's going up." And then let's say I do BTC USD.
Yeah, it looks pretty negative to me.
Divided by NVIDIA.
Oh, NVIDIA.
Yeah, but look, there's no reason to be long. Here's a blow off top for Bitcoin versus NVIDIA. It's been topping versus NVIDIA since 2013, and now it broke down from this long-term trend line, and now it bear flagged. Now it's almost, if it closes the month below here, it's breaking down below this previous low. This should be telling you something, that any Bitcoin holder, nobody should have been holding Bitcoin at all for the past 4, 5, 6 months. And they should have been at holding NVIDIA, which is outperforming Bitcoin. And that's what's kind of sad. People holding on to narratives, and it's the next best thing since butter. Well, when the capital flows start leaving your sector and going to another sector, as a chart trader, you want to make money, you want to you want to be on the good side of the trend.
Very hard to have ridden NVIDIA all the way up there. It looked overvalued before the greatest earnings report in the history of mankind. So, I don't know about you, Patrick, but to me, I'm rarely there for it's usually the end of the moves when they get parabolic. I could count on one hand how many times I've been there for moves like that. And I think that most people that are either greedy or naive. And that's what keeps them in for that long. Because anyway, just my take.
NVIDIA,
envious of the move.
I have a trick to measure greed and fear. Just look the distance from the 3-year moving average. So
yeah,
the further you are away from the 3-year moving average or any moving average, so you could put a moving average that fits your trading style, right? Because FOMO, you could have FOMO on the short term. You could have macro FOMO, like crazy stuff. NVIDIA is able to stretch from 100% to 200% away from its 3-year moving average before really starting to top out. So right now, a greedy target for NVIDIA would be 560, 570. So if it's able to extend itself about 200% above its 3-year moving average, it would be able to tag. Here, the FOMO would be nuts. Anything NVIDIA above 500, the FOMO would be crazy. But when you look at this chart, the low risk entry for NVIDIA was after 2007 all the way to 2014, and even here 2015. That 7 to 8 year base, when the price was coiling here around the 3-year moving average. There's nobody wanting NVIDIA here. There was no AI. There was nothing back then. That was the time to go long NVIDIA at sub $10. That was the time. Now,
so is it time to own gold and silver bottom line, or would you wait? Because I know just my opinion. I think we'll see the 1800 handle in gold. I think we're going to bounce. That's just I'm wrong all the time. All right. So, and actually think that cycle-wise, July, this is to you, Barry, cycle-wise, July, August is the time period. And that's just, measuring how long the rally lasted in time to a percentage of that time. We should have, 2-3 months of consolidation.
Yes.
So I'm trying to, understand what the strategy. Do you just sit in cash right now and watch the charts? Do you buy some gold? Do you buy some silver? Gold silver ratio looks like it's turned down again from 85. So maybe that was just a bounce there, and now silver's gonna lead again. People are talking about the warehouses in COMEX being they don't have enough to put in a gumball machine.
That's total noise. This is
noise.
It's crazy. This listening to comic stuff and it's noise. It makes no sense. Look at the price charts, guys. Who cares? Look, I had these people talking about, oh, Patrick, recession, silver's going to crash, all that. Yeah. Look, I have the recessions here. It's those gray overlays, or green. I'm colorblind. Look at silver price. Silver likes to bottom in the abyss of a recession. Look, March Madness. Look, it was a spike down. Look, the 2008 in the abyss, not at the beginning, not at the end. By the time we know about the recession, silver will tell you with a breakout that we're out. Look here, I could have drawn a trend line. Look at here, the bottom 2001. That was the bottom for silver. 1991, it bottomed at the abyss of that recession.
$5, $4.
Here, look at 1982 in the middle of the recession here. 1980 in the middle. 1974 in the middle. So,
take me back to the 70s.
Jesus, Dale.
Come on, man. Were you around in the 70s?
I was born 76 right here.
Okay. I was having a lot of fun before you got born. Anyway, So yes, and
Wait for this
look,
line.
yeah,
They'll wait for this line to break out. Silver right now, I think the market priced in a high probability of a recession in 2023. But the fact that silver now is tagging a breakout line here, I think whether officially or not we had one in 2023, I think the market's telling us that the next recession is not anytime soon, because if we'd be in a recession right now, if there'd be recession fears right now, the market would, the silver chart
would
would
have
look like
broken
this, guys.
yeah.
So who cares about recessions? Who cares about COMEX? If silver's breaking out, the recession could be in late 2024. You know how this chart could look like in 2024? I'll just do the last one. I don't want to FOMO people into buying silver, but
Do it,
drawings. Here, I'll just put my recessions overlay. Look, the silver chart, if it breaks out above this line here, guys, this is what could happen in, where is my
that's how
line?
you get big
Where's my
numbers.
Squiggly, where's my squiggly line? No? Okay, this one here. This could happen. And then we get the recession in 2024. This, if ever silver close above here, there's a reverse symmetry move back
Does
to
it
all-time
give you
highs.
48?
48, it could overshoot. This could happen in 2024 if ever, and crash by November 2024, and the recession could actually be here. So if people are in fear mode, let's say silver does have a confirmed breakout here above this breakout line, and it closes, and people, I'm not buying silver, it's gonna be a recession, it's gonna crash. Well, they're gonna miss all this move because they're living in fear.
Yeah.
Silver's gonna tell us once it starts breaking down here. Look, in 2008, it broke down. I'm pretty sure in August of 2008, when silver started breaking down, officially the recession was nowhere close to being diagnosed, right?
Yeah.
When was it diagnosed, that recession in 2008? It wasn't in August of 2008, right? I think everything was contained in 2008 in August. So you gotta.
It could be considered a cup, and this is the handle of the cup.
Here, yes. This is a bullish expanding wedge. This is super bullish.
But
this is a uber bullish pattern.
You want my guess? 22 to 20. Just buy it.
Well,
that's what I think.
I just don't want to get trapped. Possibly, look, it depends. If you want to have bragging rights and say, I bought close to the low, fine. But look at this. It's like months could go by. So let's say it goes back in here. Let's say you do buy the low here, and then it goes here. And then after that, it decides to consolidate for 5 more months. And then there's another instrument going bonkers, that the other, like sugar or some other things, breaking out. And then you say, oh man, yes, I did buy low for silver, but it's going sideways for another 6, 12 months. Nobody wants that.
Yeah.
Like, I don't care about buying the lows.
If you're not underwater, I don't care if it goes sideways.
Because unless you have unlimited capitals, if your capital is frozen in something that's going sideways, you're not losing money, but it's going sideways and something else is breaking out, then that's opportunity cost.
Well, you shouldn't have all your capital in one idea anyway. And if you don't have enough capital to be in more than one market at a time, you should think about closing your account.
I 100% agree. Yeah.
All right, buddy. So let's not make it more difficult just because of financial constraints that some people might have. They are not suitable for even being in the market. They should just go buy some physical and forget about it, in my opinion. Anyway, Patrick, some great looks, and this last chart I think was the key. Really is a convincing longer term bullish picture, and who knows when it's going to break out. Could be 6 months, could be 6 days. So thanks for tuning us up on that big picture look there.
That's right, guys like this, guys. This high.
Hey Patrick, I have a tip for you. Try decaf.
Jesus. Yeah. Okay. This is me not on caffeine. Here's a reasonable target.
All right. There you go. All right. Anyway, who knows? Anything can happen. And really appreciate the work that you and Kevin do, and that you come in here and share it.
Yes.
Thank you very much, my trading warrior brother, for coming back.
Always great catching up with you, Dale. Thanks.
All right. So best place for people to follow your work, subscribe.
Yeah, Twitter, guys, Bad Charts One on Twitter. All the free stuff and the paywall stuff is at northstarbadcharts.com.
Yeah. And Kevin and Patrick are an example of this kind of math. 1 + 1 = 11. They're a great team. They're a great team. All right, buddy.
Thanks, Dale.
Good hunting.
Thank you.
Rooting for you. All right. Patrick Kareem at Bad Charts 1, everybody. And that's a wrap. You could join the team in 15 minutes on the Morning Edge. Remember, don't just count your pips, count your blessings. And riding high in April, shot down in May. But boy, am I gonna be singing that tune when I'm back on top in June. Adios. Don't just count your pips, count your blessings. See you, Alexandros, Patrick Kareem, my friend. See everyone later. Adios.